$3 million tax-free strategy. And I know it sounds too good to be true, but I'm telling you, this is possible for anyone who starts early enough, and there are other strategies besides this one. I wanted to bring this up in terms of retirement because if you look at the statistics, it doesn't look that great for most Americans. According to a recent study from Vanguard that I think was done in 2022, they looked at the average and median retirement accounts for different age groups. And it actually turns out that for those 65 and older, so they're at retirement age, the average retirement balance was only $280,000. The median balance was even lower than that, just below $88,000. Now, you can't even buy a house these days for that amount. I looked at recent statistics on the median home prices, and in the US, for the third quarter of 2023, the median home price is about $430,000. So most people can't even afford to buy a median-sized home with their retirement savings. Now, hopefully they have other savings. Hopefully they already own a home that's not included in the amounts from the Vanguard study. But with the current inflation and what it may be in the future, I wouldn't feel too comfortable retiring at 65 with only $280,000 in my bank account. So for those that can plan ahead, I have a solution for you. Now, this is a really great strategy if you're younger or you have lower income, and it can also be a fantastic strategy to start getting your children to start learning about financial independence, planning, and thinking ahead to retirement, even though it seems like it's so far in the distance that, oh, that'll never happen to me. Well, hopefully it will happen to whoever is thinking that. This strategy involves the use of Roth retirement accounts. You may know from my previous videos that a Roth IRA is the opposite of a traditional IRA. This means that when you make contributions to a Roth IRA account, they are not tax deductible. So it does not reduce your taxes when you put the money away in a Roth account. However, the earnings will grow tax-free in that account. For the tax year 2023, the maximum Roth IRA contribution is $6,500 a year. So I did the math. If you're younger and you start now, or you set up a Roth retirement account for your children and they start contributing when you're age 16 and you contribute every year until 22, this means that you would have $45,500 by the time you're 22 sitting in the Roth account. And this doesn't include any earnings at all. That is simply just taking the contributions, keeping it simple, and leaving earnings out of it for now. And I chose 16 because that's generally when a lot of kids will start working, and you need earned income in order to make contributions to retirement accounts. So earned income is essentially wages, or if you have self-employment income, then you can make contributions. If you only have investment income or you don't have any income, you can't make contributions. So the limit is the lesser of the $6,500 or the amount of earned income for the year. Now, of course, these numbers change each year, so you'll want to check and make sure that you're doing the maximum that you can for each year to really maximize the potential of this strategy. Okay, so now you're 22, you've got $45,500 in your Roth IRA account. If you assume that you would earn 10% each year compounding on average until you hit the current retirement age of 66, then that account would grow to a little over $3 million. Now, of course, if you can make other contributions during your lifetime, then that will help this grow. Obviously, you can also try and maximize the rate of return, but I figured 10% was a pretty historically average amount that you could expect in this type of an account. Now, here's where the fun part comes. Because Roth IRA contributions are not tax deductible, this means when you withdraw those amounts in retirement, it's tax-free. This means if you made the contributions, as I said, and you put away $45,500 and you did nothing else other than watch that account grow, you now have $3 million tax-free in retirement. I would also add to this, because Roth contributions make a lot of sense when you're in the lower tax brackets. Well, if you're someone that's younger, your kids are someone that, that's going through college and they're just working part-time, there's a pretty good chance that they're not going to pay tax anyway when they make those Roth contributions, because we have what's called the standard deduction. The standard deduction is inflation adjusted every year. So for 2023, that's $13,850. So if someone is earning less than that in earned income, wages, part-time job, then they get the standard, which means that they are not paying any tax because your standard deduction reduces your income to arrive at what is referred to as your taxable income. This means you could earn up to $13,850, put $6,500 of it in a Roth IRA, which is not tax deductible, but because you have the standard deduction, you end up not paying any tax. So with this example, you've now earned $45,500, which you're not taxed on, and then that account grows over time, and then in retirement, you have $3 million that is tax-free. You can use this strategy even if you're working and you're earning over those amounts, because it could still make sense to make Roth contributions if you're in lower tax brackets. So if you're a younger professional or you're just getting started, then it's a great time to set up a Roth IRA and start putting money away. It could also be a great time if you're taking time away from work, or you just have a lower income year for whatever reason, or maybe you're using other tax strategies to eliminate your taxable income and get in those lower brackets, then it definitely makes sense to consider using this Roth IRA, because maximizing tax-free strategies will really increase your wealth significantly, considering that the highest potential tax rate right now is 37%. So you're potentially saving that. Plus, if you have any state income taxes, it can make a big difference when you're going to lose 40% of your earnings if you're not using a strategy like this. I hope you found that useful, and I'll see you guys in the next video.